Diversification reduces risk, and a big part of this is missing opportunities. This graph shows that a few outperforming stocks may account for a disproportionately large share of the U.S. market's return in a given year. From 1926 through 2010, the U.S. stock market provided a 9.7% compound average annual return. If the top performing decile of stocks were excluded each year, the market's return would drop to 6.3% annualized. And by excluding the top quartile of performers each year, this would reduce the market's average annual return to a negative 0.5%. Since it's impossible to reliably identify winners before the fact, the most prudent approach is to maintain broad diversification and consistent exposure within a particular asset class. This improves the likelihood that a portfolio will capture outperformance wherever it may occur. This graphic shows that actively managed funds that achieve top performance in one period typically do not repeat their success in the subsequent period. The stacked graph at left sorts the entire U.S. equity fund universe by cumulative 5-year performance relative to each fund's benchmark. As shown, the top 25% comprises 284 funds. The right box shows how these top quartile funds performed relative to their benchmarks in the subsequent 5-year period. The arrows indicate the movement of these top funds across quartiles. As you can see, only 19% of the top quartile funds repeated their top performance in the subsequent 5-year period. Additionally, 42% of the funds dropped to the second, third, or bottom quartiles. And probably the most significant stat in this graph is 39% of the original top quartile funds did not survive the entire sample period. These top managers, who were perceived as the most skilled in the U.S. equity market, showed no ability as a group to repeat their top performance. Indeed, 39% did not even survive, and the funds that did survive were spread across the sorted universe. The lesson of this illustration: choosing actively managed equity funds according to past success does not guarantee an equally successful investment outcome in the future. This is yet another example that investors are best served by establishing a long-term investment plan and by diversifying within as well as across asset classes. This slide shows the basic allocation of a two-component portfolio. Model Portfolio 1 in this example. Between 1973 and 2011, Model Portfolio 1 produced an annualized compound return of 9.34%, with annualized standard deviation of 11.14%. The next slide will demonstrate a multi-factor approach to portfolio design. The analysis will show how adding major risk measures in the U.S. as well as non-U.S. markets can increase expected returns and reduce volatility in the portfolio at the same time. Model Portfolio 5 completes this multi-factor construction by diversifying outside the United States. All 4 U.S. asset classes represented here are given 7.5% allocations. U.S. small cap, U.S. large value, the S&P 500 index, and Merrill Lynch 1-year U.S. Treasury note index. And the balance is apportioned equally to 5 non-U.S. asset classes: international large, small, large value, and small value indexes, as well as emerging markets blended index. The portfolio's 60% equity allocation is now evenly split between the U.S. and international markets, with roughly equal exposure to size and book-to-market risk factors. The historical data for the performance period shows Model Portfolio 5 producing the highest annualized compound return of all the portfolios without a significant increase in volatility. In fact, Adding the global component reduces the variability in the portfolio's return due to the lower correlation of international and U.S. risk dimensions. Compared to the original 60-40 balance strategy, Model Portfolio 5 offers higher annualized returns at 11.15%, with only slightly higher volatility at 11.39%. A globally diversified allocation harnesses the power of markets, manages the risk-return trade-off, provides broad diversification, and offers calculated exposure to compensating risk factors through structured investing.